Most investors are completely unprepared for what could happen next in gold and silver. The recent drop in metals has not just been a normal pullback, it has been sharp, emotional, and damaging. Silver especially has been hit so hard that many traders have lost confidence. When confidence breaks, markets become unstable, and right now, the technical signals are warning us that something much bigger may be building under the surface. Welcome to Gold Silver Scope, where we break down gold and silver markets in simple, clear language so you can understand what is really happening without noise or hype. Let's start with the bigger picture because metals do not move alone. They are connected to the stock market, investor sentiment, and money flow. Recently, the broader equity market has started to show signs of weakness. Major indices are struggling near resistance levels. Selling pressure has increased. Volume has expanded on down days. These are not random signals. When markets approach major tops, we often see this exact type of behavior: strong rallies that fail, heavy selling into strength, and a shift from bullish momentum to neutral or bearish pressure. The technology-heavy index has not been able to make new highs. Instead, it has stalled under key resistance and faced repeated rejection. On shorter time frames, the trend has shifted from green bullish momentum into orange and red neutral to bearish territory. That shift may look small, but it tells us that buyers are losing control. When leadership stocks weaken, the entire market becomes vulnerable. Now this matters for gold and silver, because when equity markets wobble, capital starts rotating. Recently, we have seen money move into defensive sectors like utilities and consumer staples. That is classic risk-off behavior. When investors feel uncertain, they look for safety. However, what is interesting is that even with panic selling in stocks, precious metals also pulled back. That tells us liquidity may be tightening. In strong bull phases, gold usually absorbs fear. But in transitional phases, everything can drop together at first. Let's talk about gold directly. On the daily chart, gold recently printed what technicians call an inside bar pattern within a large red candle. This is often a bearish setup. It means price is consolidating inside a strong sell-off candle. From here, gold has two possible paths. It could drift slightly higher toward resistance, potentially forming a double top, or it could break down decisively and roll over. If gold loses support, projections suggest a potential drop toward the 4,000 level. That represents roughly a 20% decline from recent highs. That is not a small correction. That would shake confidence across the entire precious metals sector. Fibonacci retracement levels show that gold has already bounced into a key 0.6118 resistance area and faced rejection. That zone often acts as a final barrier before deeper downside continuation. Now let's focus on silver, because silver looks technically weaker than gold. Silver is not forming higher highs. Instead, it is forming lower lows. That is a classic downtrend structure. When a market cannot build upward momentum, it tells us buyers are hesitant. Many traders were emotionally hurt during the recent sharp sell-off. That psychological damage is visible in the chart. Trust has been broken. Unlike gold, silver does not currently offer a clear upside target on the short-term chart. The only measurable targets are lower. Depending on how the pattern unfolds, silver could face a very deep retracement. In an extreme scenario, technical projections suggest a 61% pullback toward the 28 level. Even a more conservative pattern still suggests a potential 45% decline toward the low 40s. These are serious numbers, and they would trigger heavy margin pressure and panic selling if they start unfolding. Other metals are not helping the picture. Platinum and palladium are also pointing toward lower pricing. Copper appears to be forming a topping structure similar to what we see in large technology stocks. Selling volume is increasing. That suggests distribution, meaning stronger hands may be exiting positions while weaker hands are still buying dips. However, we must separate short-term weakness from long-term structure. If we zoom out to the 150-day moving average, the longer-term trend in precious metals is still upward. That tells us we are potentially dealing with a large pullback inside a broader bull market. But large pullbacks can be painful. The last time we had a similar setup, silver eventually fell around 65% before stabilizing. That is why risk management becomes critical during transitional phases like this. Right now, we are seeing mixed signals. The long-term structure remains constructive, but short-term damage is real. Momentum has shifted. Volume patterns suggest institutional repositioning. Volatility is rising. When volatility rises and leadership weakens, markets often enter a corrective phase that can last weeks or even months. Now let's go deeper into what is happening beneath the surface, because this is where the real story begins. When gold and silver start struggling, one of the first warning signs usually appears in mining stocks. Miners often lead the metals. If investors are confident in higher gold and silver prices ahead, they buy mining companies aggressively. But when they start selling miners heavily, it often signals caution about the metals themselves. Recently, mining stocks have faced strong selling pressure. When we apply Fibonacci retracement levels to the recent sell-off and bounce, we can clearly see that price rallied into the 0.618 resistance zone and got rejected. This is the same behavior we observed in gold itself. That kind of synchronized rejection is not random. It shows that sellers are active and defending key technical levels. Volume confirms this story. Down days are showing heavy trading activity. That usually means large players are distributing shares into strength. When you see massive volume spikes during declines, it tells you that positions are being unwound. Retail traders often buy dips emotionally, believing it is a bargain. Meanwhile, institutions quietly lighten exposure. This creates churn in the market, a lot of buying and selling happening at the same time, but price struggles to move higher. That is often a late cycle behavior. Now let's zoom out and connect this to the broader financial system. We are seeing unusual volume patterns in speculative areas of the market, especially micro-cap stocks. Trading activity has surged dramatically in lower-quality, high-risk stocks. When investors rush into aggressive plays while larger indices stall, it can signal excessive optimism among retail traders. Historically, that kind of behavior often happens near turning points. At the same time, small-cap indices are not showing the same explosive volume. That tells us the heavy speculation is concentrated in very risky names. When markets are healthy and sustainable, capital flows evenly across sectors. When markets become unstable, flows become distorted. Right now, money rotation looks defensive in some areas and speculative in others. That imbalance increases volatility. Volatility indicators have also spiked. The volatility index recently surged sharply. When volatility rises quickly, it reflects fear entering the system. The put-call ratio also jumped above 1, meaning more traders are buying put options than call options. When this happens, it often signals that traders are positioning for downside. Ironically, extreme pessimism can sometimes lead to short-term bounces because too many traders are already leaning bearish. But those bounces are usually temporary inside larger corrective phases. This is where things become important for gold and silver investors. In strong bull environments, stock market fear often benefits precious metals. But during liquidity squeezes, everything can fall together. In 2008, we saw a moment where metals initially dropped alongside equities before eventually recovering strongly. The key difference lies in how panic unfolds. If we enter a controlled correction, gold may hold relatively firm. If we enter a disorderly decline with forced liquidations, metals could experience another sharp wave down before stabilizing. Silver remains the weakest link in the precious metals complex. It continues to form lower highs and lower lows. That trend structure is clearly bearish in the short term. Even during minor rebounds, silver fails to reclaim prior resistance levels. That tells us buyers are not stepping in aggressively. Momentum indicators remain weak. Volume does not support sustained rallies. This combination creates vulnerability. Platinum and palladium are also struggling to build upward momentum. Copper appears to be forming a topping pattern, with distribution volume increasing. Copper is often considered an economic indicator. When copper weakens, it can reflect slowing growth expectations. That aligns with the broader equity weakness we are observing. Now here is the critical point. The longer-term structure for gold is still technically intact. The 150-day moving average is still sloping upward. That means we are not yet in a confirmed long-term bear market for gold. Instead, we may be in a significant corrective phase. Corrections inside bull markets can feel brutal. They can retrace 30%, 40%, or even more before resuming upward trends. That is why many investors get shaken out at the worst possible time. But we cannot ignore the risk. If gold decisively breaks key support levels and silver accelerates lower, downside targets become realistic. For miners, projections suggest potential additional declines of around 13% from recent levels if current patterns continue. And miners typically move with higher volatility than the metals themselves. That means drawdowns can happen fast. Another important factor is investor psychology. The recent violent drop in silver caused emotional damage. When traders experience sudden losses, they become hesitant. They sell rallies quickly. They doubt recoveries. That emotional shift can suppress upside momentum for weeks. Markets do not just move on fundamentals. They move on belief. Right now, belief in silver is fragile. At the same time, heavy stock market churn suggests institutions may already be repositioning. When leadership stocks weaken and defensive sectors outperform, it usually signals a transition phase. If this transition turns into a deeper equity correction, metals could face temporary downside pressure before eventually attracting safe haven flows. So we are at a crossroads. Short-term technicals are weak. Momentum has shifted. Volume suggests distribution. Volatility is rising. But long-term structural trends in gold are not yet broken. Now let's bring everything together and talk about what could happen next, because this is the part that really matters for gold and silver investors. Right now, markets feel like they are standing on a thin layer of ice. The surface looks calm at times, but underneath there is pressure building. Equity markets are showing signs of exhaustion. Leadership stocks are losing momentum. Defensive sectors are attracting capital. Volatility has expanded. Speculative areas are experiencing heavy churn. All of these pieces together create a transitional environment. For gold, the situation is balanced but fragile. On the larger time frame, the trend is still technically bullish. The longer moving averages are still sloping upward. That tells us we are not in a confirmed long-term bear market. However, on the daily chart, price action is vulnerable. The recent inside bar structure within a large red candle is a classic warning sign. The rejection near key Fibonacci resistance adds more weight to the bearish side. If gold drifts slightly higher and retests resistance, it could form a double top structure. Double tops often act as reversal patterns. If that happens and support breaks afterward, the downside target near the 4,000 level becomes realistic. A 20% decline would shock many investors who believe gold only moves in one direction. But markets move in cycles, and even strong assets experience deep corrections. Silver remains the bigger concern. Unlike gold, silver does not have a clean series of higher highs and higher lows. It is not showing leadership strength. Instead, it is showing hesitation and lower price structure. When silver underperforms gold during uncertain times, it usually signals risk-off behavior inside the metals complex itself. Technical projections for silver are aggressive to the downside. In a worst-case scenario, Retracement levels suggest a potential move toward the high 20s, representing a decline of around 60%. Even a more conservative technical breakdown could produce a 40–45% correction. These are not predictions. They are risk scenarios based on chart structure. But they must be respected because the patterns are visible. The mining sector adds another layer of caution. Heavy selling volume suggests distribution. When miners underperform the metals, it often reflects lower confidence in future price appreciation. If miners continue to lag and break lower, that would strengthen the bearish short-term case for gold and silver. At the same time, we must consider the possibility of a short-term bounce. The volatility spike and elevated put-call ratio suggest fear has increased sharply. When too many traders lean bearish at once, markets often stage temporary relief rallies. If equities bounce for a few days, metals could stabilize or even attempt a recovery move. But unless momentum shifts clearly back to bullish structure with higher highs and higher lows, any bounce may remain corrective rather than a new leg higher. Another key factor to watch is liquidity. If broader markets enter a deeper correction with forced selling, metals could initially fall alongside stocks. This happened during past financial stress events. Panic selling does not discriminate. Investors sell what they can, not just what they want to. That can create sharp but temporary drops in gold and silver. However, if monetary conditions shift later, for example, if central banks respond to economic weakness, precious metals could eventually decouple and regain strength. But that phase typically comes after volatility stabilizes, not during peak panic. So what should investors focus on right now? First, watch structure. Are gold and silver building higher lows? Or are they breaking support? Structure tells the truth before headlines do. Second, watch volume. Heavy selling volume during declines suggests distribution. Expanding volume during rallies suggests accumulation. Right now, distribution signals are stronger. Third, respect risk. This is not the type of environment where blind holding without a plan makes sense. Large corrective waves can erase months of gains quickly. And finally, separate emotion from analysis. The recent drop in silver created psychological damage. Many traders are now reacting emotionally instead of strategically. Emotional decisions in volatile markets usually lead to poor outcomes. The bigger picture is this. We may be entering a major shift phase across financial markets. If equities break down decisively, metals could experience one more sharp wave lower before finding stronger footing. Or if gold manages to hold support while equities weaken, it could rebuild its safe haven role. We are at a decision point. If you want clear, simple, and honest breakdowns of gold and silver without hype, make sure you stay connected with Gold Silver Scope. This channel is focused on technical structure, risk awareness, and understanding market psychology. And a small disclaimer, this analysis is for educational purposes only. It is not financial advice. Always do your own research and manage your risk carefully before making any investment decisions. The next few weeks could define the direction for months ahead. Stay alert, stay disciplined, and most importantly, stay informed.